When you hear MicroStrategy, you probably think Bitcoin, right? But what if that's only scratching the surface? We're about to dive into some source material that lays out a pretty wild thesis that MicroStrategy isn't just holding Bitcoin, it's a machine purpose-built from the ground up to actually outperform it. And how it's built, well, that's the real story. So the source material we're digging into here makes this really bold claim. It says this whole idea, this whole strategy, it all comes down to one single incredibly powerful mechanism. This one thing is the engine that drives everything else. And that mechanism is called structural leverage. The big idea is to use stable, long-term money to just keep buying more and more Bitcoin. But here's the twist, the absolute key. The goal isn't just to have a bigger pile of Bitcoin. It's all about increasing the amount of Bitcoin that each individual share owns. This one idea is the bedrock of their entire playbook. And that leads us to the core claim from the source material, that MicroStrategy is actually a Bitcoin amplification engine. I mean, that's a heck of a way to frame it. So you gotta ask, right? Does the data actually back that up? We'll take a look at this. This is the evidence the source points to. Ever since they kicked off this strategy back in August 2020, MicroStrategy's stock has pretty much doubled Bitcoin's own performance. This right here, this is the proof of concept for the whole idea. So how in the world are they pulling this off? To really get how this works, we've got to pop the hood. The source argues that we shouldn't even think of MicroStrategy as a typical company. We should see it as that purpose-built machine we mentioned. And that machine is engineered right on its balance sheet. Okay, so here's the basic design. On one side of the balance sheet, you've got the assets. That's their Bitcoin and their software business. Both have what you could call variable or even uncapped upside. They could go to the moon. But then on the other side, you've got the liabilities, things like convertible bonds. And here's the crucial part. Those liabilities have a fixed cost. So you've got unlimited potential gain on one side and a locked-in stable cost on the other. And this imbalance, it's not an accident. It's the whole point. So why this specific type of debt? Because it's long-term, sure, but the real superpower is this. It comes with no margin calls and no risk of being forced to sell. Think of this as their armor. It's designed to let them ride out Bitcoin's crazy, notorious volatility without ever getting a call from a broker forcing them to liquidate. That's a game changer compared to a regular trader using leverage. All right, so they have this super stable foundation, but where do they get the actual cash to keep buying more Bitcoin? Well, the source points to this really clever trick they use. They basically turn the market's endless hunt for steady income into fuel for their own acquisition engine. Let me walk you through how this preferred equity play works. First, MicroStrategy sells a product, let's say preferred equity. You can just think of it as a special kind of stock that pays a fixed, regular dividend to investors who just want some predictable income. Step 2, they collect all that cash from those investors. Step 3, they turn around and immediately buy more Bitcoin with it. And the result? The income investors get their steady, fixed payment, just like they wanted. But MicroStrategy's common shareholders, they get to capture all the potential upside from all that new Bitcoin. This move creates what the source calls the spread. It's pretty simple, really. As long as Bitcoin's value grows faster than that fixed dividend they have to pay out, all that extra value, that surplus, it doesn't go to the income investors. It flows directly to the common shareholders. It's like they're using someone else's desire for safety to fund their own high-growth bet. But issuing new stock like this leads us straight to the #1 criticism leveled against this whole strategy, dilution. So let's dive right into this, because the source argues that what critics are calling a huge bug is actually the machine's most important feature. You can see why people get worried, right? The criticism is pretty straightforward. People look at the numbers, they see the total share count just keeps on climbing, and as the source puts it, they just scream dilution. They think their slice of the pie is getting smaller and smaller. But here is where the source completely flips the script. They say, forget the raw share count, stop looking at it. They argue that the only number that actually matters for an investor is this one, Bitcoin per share. You just take the company's total Bitcoin and divide it by the number of shares. That, they say, is the true measure of value. And this just reframes the entire debate. The question stops being, are they issuing more shares? And it becomes, what is happening to the amount of Bitcoin that is backing my share? With every single one of these deals, does that number go up or does it go down? That's it. So here's the logic. A deal is accretive, which is just a fancy word for saying it adds value, if it ends up increasing that Bitcoin per share number for everybody. I mean, think about it.
If your one share represents more Bitcoin after the deal than it did before, who cares how many new shares were created? You've won. That's the argument.
Okay, so we've got the stable leverage, we've got the clever way of raising cash, and we have this whole counter argument to dilution. Now let's put all the pieces together. Because the source claims these parts don't just sit there side by side. No, they lock together to form this powerful, self-reinforcing flywheel. All right, so here's how this thing spins. It all starts with volatility in the market, which creates a premium on MicroStrategy's stock. They then seize that opportunity to sell more stock at that higher price. That cash gets immediately plowed into buying more Bitcoin. This, in turn, pushes up that all-important Bitcoin per share metric. The market sees this growth, it rewards the stock, which just reinforces the premium, and the whole crazy cycle starts all over again. And get this, because this is maybe the wildest part of the whole thesis. The engine isn't just fueled by Bitcoin's price rocketing up. It's fueled by volatility itself. And what that means, according to the source, is that this flywheel can keep on spinning and creating value whether the market is going up, down, or even sideways, because it's the choppiness, the volatility, that creates the opportunities to sell stock at a premium and stack more Bitcoin. So let's boil this all down. What's the playbook here according to the source? Number 1, use stable structural leverage that can't be liquidated. Number 2, the only metric that matters is Bitcoin per share, not the share count. Number 3, turn market volatility itself into the fuel to buy more Bitcoin. And finally, number 4, combine all of this into a flywheel that's designed to amplify value for shareholders. And all of that leaves us with the big hanging question, doesn't it? Is this thing a truly sustainable genius machine for outperformance? Or does the whole engine grind to a halt if the market ever stops being willing to grant the stock that special premium? That right there is the billion-dollar question at the very heart of this entire playbook.